Economic and commodity deflation. Well, we haven't seen economic deflation for quite some time, but is it going to be a possibility or a reality sometime soon? Mike McGlone is returning to give us an update to his thesis in his macro outlook, as well as give us a an election prediction and what will happen to commodities and asset classes outside of commodities as well after the election. Welcome back to the show, Mike. Good to see you.
Good to see you, David. Thanks for having me back, particularly on a Friday afternoon.
Happy Friday to you. Mike, of course, is a senior commodity strategist of Bloomberg Intelligence. So let's start with commodities first. Take a look at my screen, Mike. I'm going to share my screen, and this is going to be the BLS CPI index. As you can see here, the latest reading was a little bit lower than the previous 2.4, although I think it was slightly higher than what the consensus expectation was when it came out a couple weeks ago. But take a look at commodities, less food and energy. Still in deflation territory, but on an uptrend. What do you make of this uptrend? Are we going to get, a reversal of positive inflation for commodities anytime soon, you think?
Bounce in the bear market. I think the key theme from that chart is that inflation number is the trajectory is downward. It's part of the reason the Fed has started cutting rates, because the trajectory for unemployment is upward. But commodities, no, we've had a bounce, particularly if you look at food and energy. The only thing that's really strong is industrial metals so far, but they way are lagging beta. And they've bounced a little bit with the pretty strong stimulus out of China. But overall, the trend in commodities is pretty significantly historically deflationary. And I start with gold. It's outperforming everything. On a one-year basis, it's up, about 40%. And on a one-year basis, crude oil's down about 20%, almost 20%. But to me, it's a key point in time I'd like to define it from, and that is February 4th, 2022. That's when President Xi and President Putin announced their unlimited friendship. To me, that shifted the world order, and it's only getting more hotter every day. This Cold War is heating up. The war in the Ukraine, the war between Israel and Iran is heating up. And since that date, gold's up about 50%. And the Hang Seng and crude oil down about 50%. And S&P 500 is maybe up a third, 33%. But gold's beating everything. And the key question I have to ask myself is, what stops that? And I don't see any major thing that will. But I think the key iterations to really reverse that, I would think, is if we have some kind of shocking headline where President Xi picked up the phone and called President Putin, said, sorry, we're done with the unlimited friendship. We're going to be friendly with the United States because our economy is getting crushed. Or part of that is, I think, the election of Kamala Harris, Vice President Kamala Harris, as president, which I think is kind of my base case, a bit of a pressure factor for gold. So right now, as we approach the election within less than 2 weeks, market's pricing for the risk of a very controversial, very volatile next presidency from Mr. Trump. And it's not just, wouldn't be any normal president, because it'd be a complete affirmation of a lot of the somewhat unpleasant and against typical rule of law things that he has done and will be doing. Now, I can mention one book I like that really pointed it out was At War with Ourselves by General McMaster, former National Security Advisor. Expect if we get it, and so the market's pricing for that now. We don't have to dig in too much. Market's pricing for that. Yields have jumped up. Stock market's still strong. Gold's flying. Crude oil's getting hit. The market's priced for a bit of a red sweep at the moment. The question is, will we get that?
I want to come back to gold because that was important, but you've made an important point in the election first. So you are saying that the markets are pricing in a Trump victory, but your base case is a Kamala victory. So let's assume you are right and that Kamala will win, thus shocking markets. How will markets move on that?
So I think the first thing is, from my standpoint, it'll probably be a pressure factor for gold. For right now, the market's somewhat pricing in this risk-off asset, using it as, it's a backup versus the dollar. It's the only thing in the world really that's competitive to the dollar on a currency basis, consider a currency, and it's pricing in the risk in this risk off asset, and it's at a record high. So, okay, the risk is it just has a correction. So, because I think the baseline is if Kamala Harris wins, which is, again, I think my base case, I think that's what the population is going to go for. And then we get the Republican leading Congress. What that would do is harken back to the Clinton administration versus Gingrich and the Republican leading Congress back then. That's when the budget was budget was balanced, but it was the interfighting, the check and balance that it'd be ideal. It's kind of a natural check and balance that the market really needs to really stall one of the worst things that's really happening in the U.S. economy, and that's unlimited, unstoppable deficit spending. Sure, you get GDP growth at 7%, 2 to 3% when you're spending more than 7% of what you earn every year. Yeah, of course, you're going to get that. Duh. We all get that. We all know what's going on. But a good check and balance would be great. Maybe some natural austerity. So I guess maybe sometimes you can say I'm a hopeless optimist, but I think that's where things are leaning right now. But the market has to price in worst case scenarios. I give the example of virtually every start of the winter, you have to price in the potential for cold winter, natural gas goes up. And always just at the start of the growing season, you pop up grain prices for the potential for a drought. And now we just have to, I think by the end of the election, assuming we'll have a definitive answer who is going to be our next president, gosh, hope we are going to get that, then I think that's going to be more of a pressure factor for gold. But the fact is, if Trump's elected, then I think what you should expect more is just the bottoming volatility in stock market, which is 6-7 year lows. If you look at the VIX index, is no, for any president, has no place to go but upward, particularly if we have this very volatile human being reelected.
Are you liking this video so far? Well, video creation is challenging. So let me tell you about today's sponsor, InVideo, which is changing the game for video creators like me. And if you're a content creator, then listen up. I know that creating videos can be complex, but InVideo AI V3 changes that. With new generative capabilities, you can now create full-length, publish-ready videos from scratch using simple text prompts. Whether you're telling a story, explaining complex topics, or creating product ads, InVideo AI V3 puts you in control, bringing your ideas to life in minutes. Unlike tools like Sora and Runway that only generate clips, InVideo V3 creates entire videos ready for use, and the best part, it's launching in just a few weeks. With the edit command box, you can make real-time adjustments to your videos, plus voice cloning now lets you replicate your voice for narration. If you haven't checked out their current version, scan the QR code here or use the link in the description down below to try it for free. Paid plans start at $20 a month, so use my code to get 2 times video credits in your first month. Get started today. I will point out that historical evidence shows that both Trump and Biden presidencies have been very good for stock markets and to some extent commodities as well. Now, Biden's second half of this term, 2022, saw a major bear market. But for Trump, it was just straight line up with some hiccups along the way, right? Anything different this time if he wins?
The number one thing is the word he says, the greatest word in the dictionary is tariffs. There's about 100 countries in the world who have significant and have trade surpluses with the world. I do enjoy this thing when everybody country world says we want free trade as long as we can have a surplus with the U.S. So I'm very biased to the American way that, sorry, but you can't just take advantage for us forever. And Trump is picking up on that. And there's maybe 6 countries that we have trade deficits with that actually we export more to. So if we inherit these tariffs, you see a world that's already heading to global recession. Now, it's clearly the case in commodities. The Bloomberg Commodity Index on a 1-year basis is about flat, despite the stock market being up almost 40% and gold up almost 40% and crude oil down 20%. That's a side trajectory toward global recession. You see what's happening in China. They have to have fiscal monetary stimulus just to stabilize. You're depending on more and more every day. The whole world is GMTFO China. Get me the heck out of China. At least Europe and the U.S. in any way possible. The amount of EVs and massive deflationary forces from renewable sources out of China are shocking. You have to have tariffs in Germany and the U.S. and EU to prevent that deflation from tilting. And I mentioned Germany because just look what's happening in Volkswagen in Germany. You have recession tilts there very closely. You have recession tilts in Canada and Europe and very significantly in China. China's just doing what Japan did 30 years ago. Japanese GDP at $4.2 trillion is the same as in 1993. China's going that way. So to me, that's where the tilt is. And if we install these tariffs and the rest of the world continues to slow down, and if the U.S. stock market just has a normal correction, which is way overdue, that's the tilt towards global deflation. Now, it's happening in global bond markets and not in our bond market yet. So if you look at the Chinese 10-year note, it's 2.16%. That's 200 basis points less than the U.S. I mentioned this before. The top 5 countries outside of the U.S. have government bond yields that are about 100 basis points less than the U.S. Before 2008, it was the opposite. This is one area that I've been clearly wrong, hopefully just early. Well, I keep thinking the next big trade, the NBT, is going to be when the U.S. bond market just catches up to the rest of the world's plunging yields. I've been wrong. The fact that the Fed eased 50 basis points and U.S. bond yields went up 50 points is not a good sign for anybody, anything. I mean, I've just never seen that sustainable. So the Fed's easing, they're trying to help the economy, and mortgage rates and inflation signals are going up. Welcome back to the 70s. This is bad. So I look at it as that's the tilt. And if the U.S. just has a little bit of back and fill in its economy and its stock market, the whole world heads towards recession. That's already the case. That's happening in commodities and bond yields.
Maybe commodities are pricing a Trump victory, and maybe a Trump victory would imply tariffs, which maybe, again, a lot of maybes here, will be inflationary for commodities because you're adding the price to whatever imports you're getting, right?
Well, it's not inflationary at all for commodities in the U.S. The U.S. is okay. The net largest producer and a net exporter of energy, LNG, and crude oil and liquid fuels. With Canada, the excess is 6 million barrels a day. To put that in context, OPEC's rising spare capacity is around 6 million barrels a day. It's rising. Together, that's 12 million barrels a day of growing supply and demand in excess of OPEC. And if you look at the main demand source in the planet, it's China. Their total imports of crude oil are around 11 million barrels a day, ticking down about the same as in 2020. It's never really happened yet. And they're having a massive proliferation of EVs and using LNG and trucks. So that's a bad sign. It's all bad for commodities, and particularly what happened last time Trump started the trade war with China. It was overdue. I think he had some really good points there. China's been taking advantage of the U.S. for a long time. And what happened to grain prices? Reached multi-decade lows. And right now we have a massive excess of grain. Just got through harvest, or getting there through harvest. The ground piles are growing. We got a pretty substantial excess of crude oil and liquid fuels. With the market, every day the market's above $56 a barrel, and then WTI crude oil, we get that increasing supply versus decreasing demand in the U.S. It's just the trends are unstoppable. So tariffs overall would be initially bad for the rest of the world. It would be somewhat short-term inflationary for the U.S., but really bad for commodity prices, for a net exporter that's completely dependent on exports to keep prices elevated. So let's look at here. I will tilt over a little bit. Just look at, we have declining demand for diesel, unleaded gas, and mostly diesel in the U.S., Europe, and China. It's virtually never happened together without a global recession. What changes that? And I look at it, typically it takes lower prices to find a plateau.
Kamala winning. All right, let's assume she wins. Let's play this out. So what does her foreign policy look like? What does that mean for volatility in the global arena? We're talking about volatility today. It's kind of the theme of our conversation. What do you think? Does that play a role in your analysis?
Absolutely. It would be more of the same. The bottom line is anything she tries to do as far as spending in programs will be pushed back by the Republican Congress, which will probably come out and say, oh, remember those old days of austerity and the contract with America and this rising deficit? I think they'll go back to that mantra just because, it'll play out well politically. And, we have that whole inflation thing. Remember, that was the main thing that hurt your average voter. It didn't hurt rich people. It helped rich people. So to me, that's the somewhat maybe hopeless optimistic view. But again, it's kind of more the same, David. It's nothing really new. But if you have Trump in there, and he will be completely emboldened compared to last time he was president, and he will probably have only yes men on his cabinet. We've seen what happened with people who push back on him a little bit. That's a very extreme case. And that's only bullish for gold. I mean, it's definitely bullish because it's bad for crude oil. Drill it will. But that's one of the most enduring trends in commodities already. How is gold going up and crude oil going down? I mean, it's been lasting since about 2008 when crude oil peaked at 147, and now it's less than half that price. Again, it's the shocking difference of this Trump 2.0, and we see all the data of his rhetoric and everything, extreme rhetoric, pushing back in the military, pointing out the military might be used for internal conflicts, and pushing back on the Fed, on the dollar. I mean, it's just stuff that I think it feels so much shocking, which is part of the reason gold is at record highs.
Oil here. Oil usually spikes when there's a war. Nothing's going on right now in terms of volatility in the market for oil. It's just trending downwards. And I don't know. I'll let you answer this, but I don't know what this is signaling right now. Just no chance of, or very little chance of any eruptions going on in the Middle East or perhaps in the Ukraine.
$40 in WT crude oil is a new $10. And I appreciate you mentioned wars. It does spike for wars, but those war spikes almost always end up in enduring bear markets that are resolved. The last two times was Iran, Iraq, starting in the 80s, bottom around 10 in 86, and then Iraq, Kuwait. Popped up to 40. I remember being in trading pits, getting ripped off, my face ripped off at first, and then making some good money afterwards. It bottomed at 10 by 98. We're going to that level now. You have to get below $56 a barrel in the U.S., or we're going to continue with this supply-demand imbalance. And it's what I pointed out. Diesel demand is declining across the world, not just the U.S.
Yeah.
And diesel is the grease of the global economy. So, and it's being replaced by technology. That's what's happened. That's what's different from the last time we had these kind of wars and crude oil spiking. So I will own that if I'm wrong. And I do respect, one thing I do have to say is I just say it. I don't trade anymore. I used to trade. I have complete respect for our listeners and viewers who actually run money. I have to, but I will own that if I'm wrong, because that's what happened. Natural gas. Fully expected that when it dropped below the cost of production to its lowest price this year since 1990. Now it's bounced a little, but that's typically what happens. You have to get below the cost of production. This is nothing new. Adam Smith wrote about it 250 years ago. And then you bounce. Corn is very close. It's around $4 a bushel. The low this year has been about $4.670 or so. The cost of production in the U.S. the low has been around $3.75. We estimate the cost of production is around $3.75. Probably has to get below that level to really offset this excess of supply and really kick in that demand. And crude oil is the biggest one of its all, but we mentioned earlier, it's being somewhat elevated by geopolitical tensions. But you have to ask yourself every day, what part of what's happening, most notably with the wars, particularly in the heart of the Middle East between Iran and Israel, is reducing supply of crude oil. Now, OPEC is deliberately cutting back supply because they have to, just like China has to be stimulating their economy because the whole demand pull situation is trickling downward. And a lot of what's been driving the global economy is still the U.S. Just imagine if the U.S. puts tariffs on the rest of the world. All these countries can't just export to the U.S. It's an accident waiting to happen, akin to the Smoot-Hawley Tariff Act in 1930. But the big difference is the U.S. stock market is the most elevated versus GDP. It's 2.1. That's the most elevated in 100 years versus the rest of the world stock market, the most elevated ever, particularly if we go back 50 years, versus a commodity market versus most elevated in 25 years. And the key bottom line for me is it's about at a 17-year high, although it's been stable for a while, versus gold.
How important are tariffs for inflation? By the way, Biden doubled down on Trump's tariffs, so they're still there. So let's suppose whoever is in the White House removes tariffs, just as a thought exercise. What happens to inflation? Is that more or less inflationary?
But first, it's more inflationary, particularly initially on a U.S. scale, because it'll be in the U.S. We won't have all those cheap goods. But you made a good point, David, which is part of the reason I love speaking to you. It's very profound. Is what Trump has done has really, a lot of the main things he's done has been adopted by both parties. But what's happened also is those extreme views, they were not being done before. He helped us do many of those things, pushing back on China. It was way overdue. The tariffs. Yeah, I agree. When you have the world's reserve currency, the concept of free trade doesn't work. The whole world takes advantage. And he's right. They have been. That's got to stop a little bit. I look at a concept of new tariffs. We should just come out to say every single country in the world that says, hey, you have, running complete surpluses with us. You're spent your deficits with us. We'll give you a year. And if you don't start doing something about it, we're going to institute a tariff, particularly if we're providing your security. It's just a rational thing to do for a country that's going in pretty significant deficit spending. But initially, tariffs just make everything more expensive for the country that's importing. But it's the global tilt for all those countries that are not going to be able to export to the U.S. And the U.S. is going to find, it's great for domestic production, which is part of Trump's whole mantra, pushing back on the dollar and downward on the dollar and pushing back on the Fed, which means volatility and potentially a weaker dollar. But and stronger gold. But it's indisputable that, at least in the short term, it depends how it works out.
Let's go back to gold now. Gold, $2,700 was breached earlier this week. Now it's at $2,753. New all-time highs every time we speak now, Mike. So you talked about all these volatility factors that we discussed. We have not discussed 10-year yield and the real interest rate. So the real interest rate has somewhat fallen over the last couple of weeks. Take a look at my screen here. This is from the St. Louis Fed. I know it's not the latest data. It's a bit outdated, but anyway, the trend has been on a downward path since the beginning of July, or the beginning of June, rather. Maybe that was partly the reason for gold's ascent. What do you think?
Um, I think it's more right now starts with those are sometimes there's always different things that drive markets.
Sure.
And the elephant in the room for gold is the unlimited friendship and the rapidly heating up global Cold War that's getting hotter every day. That's number one. Central banks are buying gold. They ain't buying silver. They're buying gold, led by China. And they're still doing that. And they should be. I mean, it makes sense after what happened with the dollar. Now, that is another factor, but to me, that's more peripheral and like even commitment of traders and ETF holdings, that stuff matters. It used to matter a lot more, but right now it's the overall. So I think the key risks to gold right now is what I pointed out. If Harris wins and we have a little bit of calming down of this risk of President Trump as a president, and we have a little bit of austerity, and gold has a backup. Gold's overdue for a backup. I think at some point. So that's one thing. I lost my hair trying to figure out the short term in things like markets. I used to do that for a living with leverage futures. So just imagine that typically it's 20-to-1 leverage when you're a futures trader. It was my background. But the thing about gold is we're overdue for a bit of a correction, which would probably be healthy. But the key question is what will cause it. To me, the most bullish case for gold to me is at some point when we get a little bit of back and fill in the U.S. stock market. And as I mentioned, the U.S. stock market is so expensive. And with the stock market on a tear and U.S. 10-year notes and T-bills leaning, still yielding over 4%, why buy gold? That's just starting to shift. It's early days. But gold's front running that. So to me, overall, the macro is important, but the next key catalyst for gold to go higher is when the U.S. stock market has a bear market, maybe just doesn't go up for every single day for, it has a little bit of a pullback, but that can come back on the back of what normally happens after you go up too much. Is go down. That's what's happening, I think, at some point in the stock market. So to me, the next big driver, and I mentioned the risks, which I think are short term with President Harris getting elected, and long term and very unlikely if President Xi, if there was some kind of regime change or they just tilted in China, say, no, we want to be friends with the U.S. because you are kind of like our best customer, and Europe, we're kind of like our best customer, and being the decisive enabler of a war in your backyard is just kind of silly. And we had one person do that. That's why history is going to view that. And just hopefully it doesn't turn out too bad. But right now we do have a Cold War that's getting hotter every day.
I'm not saying it will, but if we have a de-escalation of geopolitical tensions, do you expect the war premium of gold to disappear?
Yes. Okay. So that's what's missing right now. I remember I grew up in duck and cover, and then we had this wonderful many-decade period with a few bumps in the road of détente and relative peace in the world. But now we're completely the opposite, yet we have the U.S. stock market priced for complete perfection. I mean, it's the highest per GDP in 100 years. Now, okay, there's other ways you can measure it. But in the shorter term, volatility is extremely low, which is a key indication in 2008 for markets go down. And even just its 100-week move average, it's extremely high, should revert. But to me, it's the macro big picture of that expensive stock market that I just can't take my eye from it. So here's one thing I want to tilt over and lean into shorter term. You look at everything you can. The correlation between Bitcoin and the stock market, S&P 500, 60 days is the highest ever. It's never been that high on the way up. Correlations always go to 1 on the way down. So if stock market goes down, all correlations go to 1. That's what pushes risk assets like Bitcoin down. The correlation between copper and the S&P 500 is very high. Yet copper's lagging. So those are kind of things I look at that markets just ready for on the cusp of some big moves. And I think that's what gold's picking up. And I think the next big trade at some point will be that NBT will be the U.S. Treasury bond yields catching up to the rest of the world. Now, if I continue to be wrong on that, it's partly because wonderfully, the U.S. stock market's just stalwart and won't stop going up.
Yeah, I mean, I like how you challenge yourself and you force yourself to think what will make me wrong. I mean, that's what a good thinker should do. But take a look at my screen one more time. Silver's been outperforming gold finally. Year to date up 40%, gold's up 33%. New highs for silver. I think it was highest since 2012. Correct me if I'm wrong. Let's just zoom. Let me just make sure. Yeah, it's the highest in many happened? What happened this year? Well, I mean, I know it's been following gold, but anything specific with silver?
Well, I view gold as much more macroeconomic and silver much more technical. It's called the devil's metal for a reason. I used to have hair trying to trade silver. Now I look at it, sure, it's breaking out. It's good. It's converted 30 resistance to support. Probably going to maybe revisit that level, maybe get up to 40, but it's completely dependent on gold going up at the moment. So all the precious metals are catching up: platinum, palladium, and silver. The significance, I think, of silver is much more of an industrial metal than it was in the past. I mean, every single day that goes by, gold is demonetizing virtually all the metals, most notably precious metals like silver. And the bottom line is, to me, copper looks like it's a pretty good peak. Silver is much more correlated to copper than it was in the past, and still somewhat correlated to gold. But I love watching that gold silver ratio. It's right around 80. 80, I think, was first traded around 30 years ago. I think when Sir Isaac Newton was the head of the mint in the UK, it was around 16. That's what was considered the amount of
Sorry, his name
silver in
is
the
Sir
earth
Isaac
crust.
Newton.
Yes, did I say that? I did not pronunciate properly, as my mother said. Yeah, I mean Isaac Newton. But even still, even the
Okay.
U.S., when we were on the bimetal standard in the 1800s or so, it was around 16 to 1. But the key thing is that's an enduring upward trend at some point. Particularly, that ratio goes higher. That's gold versus silver, when you have things like in disinversion of the yield curve, which is getting started, unemployment going up, the Fed just starting easing, and bottoming stock market volatility. This is all getting started. So the high for around the financial for the COVID spike and that big pump in liquidity, everything was around 100. It's been hovering around 80. 80's been an enduring pivot. I think it's more likely to go higher, but it's not for good reasons. So for silver to really and remember how that's changed. Silver basically trades with almost 2 times the volatility of gold. So the fact is, silver's up about 46% in the year. Gold's up about 40% in the year. Silver should be up 60% if it traded with its normal volatility risk to gold. Now it's catching up, but it's catching up also a lot of speculation, just like copper. Future speculators are involved. And the bottom line is you have to expect a lot of China to just come out of this malaise it's in, which I think is enduring and long term, right away and do well, and then just the whole global economy to pick up. Because silver is an industrial metal. Gold is basically money store value.
Okay, so which of the assets we discussed today you think will have the most upside post-election?
If my base case is right, I think U.S. Treasury long bonds will be the next big trade, the NBT. Been early, been wrong. Was early on gold and was wrong for a while. It worked. Was early on short crude oil and was wrong for a while. But those are part of my tilt for that reason. Is we're seeing global deflationary forces from most commodities. I think copper is more likely to head lower with bond yields, and follow what's happening in China with bond yields, and that would all have a big. It might be delayed a lot. It might reverse it if we have a red sweep. Now, I don't think that's going to happen, but the fact the market's already priced for it means the risk is it doesn't get it.
Okay, final question I have for you, Mike. Do you miss your trading days?
Oh, not at all. So, I do miss, first of all, the P&L part was tough. When trying to raise a family as a trader, I don't suggest that for anyone. But I do love being exposed to it. And I think it really helped me learn so much about markets. The best way to learn is having run some money. And I do find that's what sometimes analysts, I'll see things they write and I can say, yeah, he probably never ran money. And I mean, here's a lesson I learned. First day I walked in the Chicago Board of Trade in 1988, I went to the water fountain and there was a little sign right by the water fountain that said, "The ultimate seduction, other people's money." And I'm like, oh, okay, that kind of makes sense. I got this. I did that for a long time, learned it, but it's a foundation that got to me where I'm now, and that's where I really respect the traders there. And but that's where I really appreciate what I do at Bloomberg Intelligence. I have no bias, buy side, sell side, no position, everything, and just make sure to editors I don't say any stupid things and that's too political and stuff. But that's the benefit of having been an ex-trader. I can also tell when I've been wrong or would have been stopped out, and so that's how we look forward. And that's why I still think I look at the most stretched things I see is gold is really expensive versus treasury bonds. I mean, on a 50-year basis, just way too high. And the stock market's way expensive versus everything. Just at some point, just a little reversion. And you got the start of a really big trade. And that is what sparks that. We'll see what the election does to either make or break that, some of the reversion potential.
Okay, you wouldn't take some of your pocket money and gamble with like a Dogecoin or anything?
Oh no, so I have. So that's the thing at Bloomberg. I'm not allowed to trade. They help me get away from that addiction, formerly addicted. And I have 30 days minimum. It's only buy, and that's it. No options and things. So I've bought things that are related to Bitcoin years ago. I couldn't really buy Bitcoin. I wasn't allowed. So I bought things like MicroStrategy. It just got way. I mean, it gave me a 10x. I'm like, oh, this is a lot, and it just seems so. That's the whole thing. I mean, I can buy a little Doge, but if it's de minimis, who cares? But I did initially pre-approved by all my employer to make sure I can understand this space. And this was 5, 6, 7 years ago to understand cryptos. Opened up a bunch of wallets and bought and sold maybe $100 here, $100 there. And I still own some of that. And mostly just to trade. But the key thing I learned is this is a massive speculative excess of trade going on in cryptos, and Bitcoin's the leader. And that's why I'm really concerned. If I can tilt over, the Bitcoin basically trades about 3 times the volatility of gold in the S&P 500. Now, I love hearing, it's the mantra you hear. When you hear everybody says the same thing, be careful. Oh, Bitcoin's going to be a risk-off asset and it's going to do great because of deficit spending and all that. I'm like, sure, as long as the U.S. stock market goes up. So that's why I like to tilt over to Bitcoin. You see that chart there? Bitcoin looks great, right? On a standalone basis, so does copper. But if you compare it to typical things that's highly correlated with beta, divide that by beta, it's a downward trend. It's rolling over, which is to me the risk. So I pointed out earlier, with the highest correlation ever, 60 days on the way up for Bitcoin and beta, S&P 500, the risk is beta just backs up a little.
Let's close off on Bitcoin. Okay, so we haven't had a chance to talk about Bitcoin yet. Bitcoin, I've been hearing from the crypto people, Bitcoin and cryptos are pricing in a Trump victory. I don't know what they mean. Maybe clarify for me, please, because it's been on if you just take this line, draw a trend, the longer term trend line is down from the start of March.
Yeah, I like to look at the 100-week or 200-week moving averages. Most of them rolled over. Now it's back above those levels now. But Trump I really enjoyed what he did, way delayed for the election. Things that we wrote about years ago, that any politician, a regulator, a leader in this country, in the U.S., that pushes back on crypto is basically not understanding the space. It has votes, it has money, and its base layer, its most widely traded crypto is the U.S. dollar. It happened organically. If you push back that and you're American, you're probably anti-American. So he figured it out. It's an election. Now the key thing I enjoy is they're all on top of it. All the politicians realize, all right, I might as well be favorable to this space that went for the U.S. as its base layer. The most Tether, again, it's the most widely traded crypto. It's not Bitcoin. And the technology is revolutionary and overwhelming. The tokenization of assets is just a much better way to trade, even better than futures. But the bottom line is right now, Bitcoin, I view as it put in a pretty enduring peak in March for good reason. It had a perfect storm for new highs. The ETF launched in the U.S., the halving and record-setting beta. And since then, it's been lagging, as you showed in that chart. But the question is, will it catch up? And I think it's more likely to put an enduring peak, and maybe we can go back there again and make it difficult. But to me, the basic risk now is it's so dependent on beta going up. The best days of things we wrote about for 5 to 7 years of what's happening now, it's basically in the mainstream. You can buy and sell an ETF. You can trade options and futures. You can hedge it any way you want. It still trades 3 times the volatility beta. It should go down. And now it's just much more in the mainstream. It's no longer the best days of Bitcoin are over.
This really, are you okay? So let's talk about that. The best days of Bitcoin. Bitcoin dominance is going up. It's at the highest point since 2021. Now 2021, this happened because there's a surge of tokens and altcoins. That altcoin space exploded, retail space exploded. But now, are we going to see a normalization back to pre-2021 levels? I'm not talking about here when there were no altcoins. I'm talking about here at 70%.
Well, I used to say there's Bitcoin, Ethereum, and 10,000 wannabes. Now there's 1 million wannabes. So massive oversupply, massive speculation. Nothing against speculators. Guilty, ex futures trader, 20 to 1 leverage, typical. The problem with that chart is typically Bitcoin outperforms alts when the stock market goes down. But it's doing that with the stock market making record highs, NASDAQ, and that's typically not a good sign. You're just seeing Bitcoin. It's becoming more of the beta in the space, which it should. It's proving that most of those altcoins are just speculative, excessive, that are probably going to go down. But the key thing is that Bitcoin is the beta, it's the grandfather. It's the one that really matters, and its correlation to this S&P 500 is at the highest ever on 60 days. So stock market has to go up. So here's the key thing that people used to say. Bitcoin was the fastest horse in the race. Well, right now it's indicating on that chart you showed earlier, and in chart versus the stock market and the high correlation, it's lagging the stock market that the race might be over. Is there a good reason for the race to be over? I just been way too early. Been pointing this out for a long time. The U.S. stock market is so expensive on many measures historically, and Bitcoin has been the best leader on the way up for at least the last decade. Maybe it's leading this leading indicator 24/7 traded risk asset. I mean, it's perfect for trading. Is telling us that the race is over, and we'll see what the election has to say.
Thanks very much, Mike. Where can we follow you?
On your show. Thank you very much. I enjoy being on your show.
Thank you for coming.
I'm on X at Mike McGlone 11 and LinkedIn, and if anybody sends me a message, or I'm happy to add them to my distribution list.
All right. Fantastic. We'll put the links down below. Thank you, Mike, for coming on the show again, and happy weekend to you.
You too, David. Thank you.
Thank you for watching. Don't forget to like and subscribe.